Hey option traders, for today's trading strategy, we're taking a look at a synthetic long stock trade in IYR. Property has a valuable place in many people's portfolios, especially amid times of economic uncertainty. So here's a strategy where you can use options to gain exposure to the real estate market without having to buy a house or an apartment. So we're going to use the iShares US Real Estate ETF. This strategy is called a synthetic long stock trade, and it involves selling an at-the-money put and buying an at-the-money call. A synthetic long position has similar exposure to owning 100 shares of the underlying stock or ETF. But the advantage of the trade is that an equivalent exposure to owning 100 shares can be gained for only a fraction of the cost. So let's take a look at the ETF in my trading account and set up this trade together. So we're on my Thinkorswim dashboard, and I'm going to show you how to set up this trade firsthand in your trading account. First, you're going to want to type in IYR, which is the ticker symbol for this ETF. And we're going to be looking at options contracts that expire the week of January 21st, 2022. And this area here is where you are going to want to select your strategy. So for this, it's going to be a caller/synthetic strategy. And the strike prices can be seen here in the middle panel. Now we're going to be looking at the 88 strike, and we're going to want to sell an 88 put and buy an 88 call, which I have set up down here. Buying call and selling the put. In total, the trade will bring in around $27 of premium, and the maximum profit on the trade is theoretically infinite. The key thing is that the same exposure would cost about $8,887 if you were to just straight up buy 100 shares of the ETF. But investors should be aware that even though the option trade generates a premium, you could still lose roughly $8,655 if the ETF went to $0 a share. So despite the fact that this trade can be placed for a credit, the exposure to loss is still almost as large as it would be if you were to just go long the ETF, given the inherent leverage in the options. But like I said earlier, the key advantage is you're going to be able to gain equivalent exposure to owning 100 shares, and you're doing it at a fraction of the cost. For this synthetic long position, the margin requirement would be around $2,300, so the investor could use the leverage power of the options to trade multiple synthetic long positions with the same amount of capital required to purchase $100 or 100 shares. So of course, leverage is a double-edged sword, and if the ETF drops, the losses will be magnified. This strategy can be used on any stock or ETF. Just be careful to watch your exposure and not take on too much leverage. So to recap, this option trade involves selling a January 2022 88 put and buying a January 2022 88 call. The total premium collected on the trade would be around $27, and the max profit on the trade is theoretically infinite. And there you have it. I hope this was a helpful trading strategy. Remember that options are risky and investors can lose 100% or more of their investment. So make sure you practice with a virtual trading account before risking any real money, especially if this is new to you. And check out investors.com/futures-options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.